Hello, everyone. Thank you very much for joining with us today. I'm going to be presenting a little bit of a shorter webinar today just to kind of remind people that we have some upcoming deadlines. And if you're looking to do a few things, maybe it's important to understand what those kind of things look like with regards to Roth conversions, maybe getting a solo 401k set up and what that might look like for your contribution deadlines going into next year and what these kind of plans look like in a whole. If you do have any questions, I do encourage you to type those into the chat box. As all of your audio has been muted, I am happy to review anything that you might have, but I will probably get through this webinar in about 30 minutes, 40 minutes today. Again, it's not, not intended to be something that's a deep dive into case studies, so just a lot of high level stuff to make sure you are positioned for the end of the year, because as we all know, the end of the year gets exceedingly busy, especially with this week being Thanksgiving, and then we have maybe 3 weeks until we have Christmas and Hanukkah and all the fun things that come with the end of the year. So with that said, let's go ahead and get started. Again, if you do have any questions, type those into the chat box. I'll address those as they come up. And if you would like a copy of the slides, they are attached as a handout here today as well. So a little bit about myself. My name is Alex Perny. I've been with Advanta since 2012. I've been in my education and business development role for about the past 6 or 7 years, and I started off the beginning of my career doing actual hands-on investments for clients. So I have a lot of great bases of knowledge to really help you out if you have any questions, maybe concerning an actual investment or how something's structured or getting plans set up. Most of my years sitting there helping business owners get things like solo 401k plans established, doing SEP IRAs, looking at Roth conversions, making sure people understand how much contributions can be made, and all sorts of great things that kind of come with the end of the year. And there's some really interesting strategies that can be employed as well. A little bit of information about us here as a company. We have to have a little bit of a disclaimer because we can't give tax or legal advice. Advanta IRA and our employees do not provide investment advice, nor do we endorse or promote any products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. A few takeaway points that are important to learn here today is that you can choose the investments. Any of your old former employer plans can apply to maybe rolling over or getting something started in addition to making contributions. And if you do make an investment, any and all expenses that are associated with that are going to need to be paid by the IRA. A few opportunities here, especially for those of you that are looking to get started or maybe utilize retirement plans a little bit more. If you're a real estate professional, you can certainly help to guide clients in a pathway that will help them to understand how these plans can be utilized, and understanding contribution limits is very important for that as well. Your clients can realize great returns, and also you can expand your capital base utilizing these types of plans as well. So I always like to make sure that's included, especially because we get a lot of people that are professionals and looking to kind of educate their clients maybe on what these types of plans might offer and how they can be utilized as well. A little bit about Advanta IRA. We have well over 20 years of experience and are very proud of our great knowledge base, with plenty of people that have been here doing self-direction for a lot of them for 10 years or more, myself included in that. We administer over $3 billion of assets under administration, and we have a great network of people that can always help to guide and facilitate different types of transactions and helping you to understand exactly what's going on and deploying these funds in a very effective manner. And we also very focused on a very personal touch when it comes to administering our clients' investments and assets. We have dedicated account management for any and all of our investments and clients that are here at Advanta. We also have a great learning center. So if you want to learn more, get more engaged, we have bi-weekly events, maybe with the exception of this week, with it being Thanksgiving, but we have weekly webinars. We also have a podcast that I host, The Alternative Investing Advantage, where we have a lot of great guests kind of digging into a lot of very interesting and topics that you maybe don't see a lot of information on that is being put out. And we also maintain an up-to-date blog with a lot of very good industry insights as well. So kind of important to understand is, what is a self-directed IRA? It's a unique type of investment account that allows alternative investments, which you can potentially build tax-free and tax-deferred wealth at a faster pace than more traditional methods. And the interesting thing is that although a self-directed IRA has a large spectrum of different things you can invest in, the rules and regulations regarding them are going to be uniform across the board. So it's not a whole new playbook that you have to learn when it comes to self-directing, but there are definitely some high-level things that you need to consider when it comes to actually maintaining and utilizing one of these types of plans. Now, self-directed IRAs, again, offer a great variety of different things that people can invest in. So looking at it from a high level, yes, it's great that you can create some great tax deferment, making contributions, understanding what goes into these plans. But when it comes down to it, the other part of the equation is understanding what you can actually invest in. And some of these assets can include real estate, mortgages, different private promissory notes, private placements, precious metals, cryptocurrency, and a whole lot more as well. And we have plenty of different educational webinars that focus specifically on these types of investments. And people often ask, why haven't I heard about a self-directed IRA? Well, it's really not the most common type of thing to be doing with your retirement. Roughly in the United States right now, there's almost $37 trillion of retirement plan assets that are in different types of retirement plans, from 401ks to IRAs. And roughly about 4% of that is self-directed, and maybe even a smaller percentage of that self-direction, because that includes people that just pick and choose their own stocks, is actually invested in alternative assets. And again, why people are choosing to do this, it can be a new source of capital for different investments that you have going on. Maybe you're getting tired of the stock market. Certainly right now, it's maybe a little bit harder to make that comparison, considering the stock market's been doing very well, but you do get away from that kind of roller coaster effect when it comes to getting fatigued. You have a much more stable asset basis when you're investing in tangible assets, and again, the tax benefits can be immense. And again, the asset types, a lot of different things that people look at when it comes to utilizing these plans. They can be immense, but they're not necessarily just constrained to a simple type of prescription that the IRS puts out. There's a lot of different things that you can do. Again, not trying to focus too much on there, but if you're more of a visual learner and trying to get a little bit more of a well-rounded understanding of what these accounts can do, besides just offering the ability to invest and contribute money, it's good to kind of have that laid out. But again, it can be anything from real estate to paper and all sorts of other alternative assets. Now, what type of plans are out there? And these are the slides that we're going to be kind of focusing a little bit more on. There's different types of plans, and they have different aspects when it comes to timelines, deadlines, and different things that you want to look at, as well as the contribution limits are going to be markedly different as well. So you're going to have the main ones that people look at, which are going to be your traditional IRA, your Roth IRA, and inherited IRAs, which can be either Roth or traditional. Now that's going to really kind of boil down to whether it's pre or post tax. Traditional IRAs, you're deferring your taxation. So if you're adding in contributions to that plan, you are going to be getting a tax deduction unless you, again, can make over a certain amount of money, in which case it would be potentially non-deductible. But again, that's a little bit more of a question for your tax preparer. But again, anyone can make a traditional IRA contribution. It does not matter how much money you make. Now, a Roth IRA for making direct contributions does have an income limitation. It changes from year to year, but again, it's going to be determinant on whether or not you are a single filer or a married filer, or if you're married filing a separate tax return, as to what that amount is going to be for your restriction on making a direct IRA contribution to a Roth IRA. Now, Roth IRAs can be held by anyone. All right, so with regard to that, again, we have the several different types of plans that can be utilized for this type of for these different sorry, I'm just getting a little hemmed up by the question there. So again, traditional and Roth IRAs are really going to boil down to whether or not you want a tax deduction and tax deferment, or whether you would like to pay taxes now and then pay no taxes later on down the road. Now, keep in mind that, again, anyone can have a Roth IRA. A big kind of misconception is that people making over a certain amount of money cannot have a Roth IRA, which is simply not true. And we'll get into some of the aspects of doing Roth conversions here in a minute. There's also different types of savings accounts that have specific types of utilizations that you need to look at as well, mainly the HSA and the ESA. HSAs are phenomenally powerful types of retirement plans that are specific to having certain types of insurance, mainly a high deductible healthcare plan, along with being able to have tax-free distributions for medical reimbursements and tax-deferred contributions. So you get kind of a nice hybridization between traditional and Roth aspects with HSAs. And ESAs, while they have fallen a little bit out of favor and they really don't get addressed too much by the IRS on their periodic updates for contributions, are again a great avenue for you to have some tax deferred and potentially tax-free distribution savings for qualifying higher education expenses as well. However, the contributions limits for those are very low, and we'll get into those a little bit later. And what a lot of people are very interested in, and what I've been doing a lot of work for my clients in recent weeks, are solo 401ks, SEP IRAs, and simple IRAs. And again, we'll get a little bit more into what would attract someone to one of these plans versus the other, as well as the contribution limits and deadlines associated with each here in a moment. Okay, so individual plans. Your traditional IRA, what's the criteria? Anyone with earned income is eligible to contribute. So if you have earned income, now, if you're someone that just makes all of their income from, let's say, capital gains, or you have no type of income in your household, you can't make a contribution to this type of plan. However, if you do file a married joint tax return, and let's say someone is someone that stays at home, whether or not, whether that could be for taking care of children, whether that could be for any number of reasons. But if you have one person that's the primary breadwinner of the household and you file a joint tax return, both people can have a traditional IRA and contribute to that plan, because the IRS looks at it as a household income. People like to call this a spousal or a marital IRA. I don't really like that term because IRAs inherently are going to be individual, but you don't necessarily have to each individually have a job, but you have to have earned income in that household and file a joint tax return for that as well. Now, deductibility of a traditional IRA contribution is going to be based on the amount of household income, and I would just check with your tax preparer, because they do change, and they have in recent years changed throughout the years periodically. So I don't necessarily put that on here, because it might even change with a periodic update from the IRS before you file your taxes for next year. So keep that in mind, is that deductibility of a traditional IRA contribution may or may not be fully realized by you, and it is a phase out. It's not necessarily making a certain dollar amount is no longer deductible, but again, there is a phase out for that. And with regard to adding money in, you can make an annual contribution, and we'll go through the actual numbers of these in a given year, and you have up until your tax filing date, the timely filing date, to establish and contribute to a traditional or Roth IRA. So you don't necessarily have to have one established by year's end to either make a contribution for this year, or you can open it up in next year and still make a contribution for the previous year. So a good degree of flexibility. However, unless there is some type of special dispensation for maybe something like a disaster or something else like that, everyone basically is lumped into having to establish a traditional or Roth IRA by their tax filing deadline without extension. So you're lumped into having to open up a traditional or Roth IRA to make the contributions by your timely filing deadline in April. Now, something that's very important to look at, especially for deadlines, is the ability to do a Roth conversion. Roth conversions is the mechanism for taking pre-tax retirement dollars or assets and moving them into a Roth IRA. Now, remember the difference between traditional and Roth IRAs. Traditional IRAs, you get the tax deduction going in, but you pay taxes on the way out. Roth IRAs are going to be paying taxes now and then paying no taxes in the future. And remember, anyone can convert to a Roth IRA. If you have pre-tax retirement plan dollars, you can always convert into a Roth IRA no matter how much money you make or don't make. But Roth conversions are always going to be considered in the tax year in which they're done, which again is going to be from January 1 to December 31 at midnight. So if you want to do a Roth conversion, you're at a very interesting time of the year to do this, because most people, as of now, typically understand how much money they will have made or are going to make in a given year. So they understand what their marginal tax bracket is going to be. Because if you do a Roth conversion of pre-tax traditional assets, let's say it's $100,000 of either cash or applicable asset value that you're looking to convert, you have the potential to to split that conversion between 2 years. Because if you were to do the whole $100,000 conversion this year, you would get a 1099 stating that, hey, John Smith has converted $100,000 and is claiming an additional 100 grand of income this year. You can't do a previous year Roth conversion. So after the first of the year, anything you want counted on this tax year is gone. So you have to do it by the end of the year. So if you wanted to maybe split your tax bill between 2 years, you can convert a portion of your cash or assets before 12/31 and then convert the other portion directly after that, effectively taking what would be a very sizable amount of income to show on a given year and bifurcating it between 2 years within maybe the time span of a week. Again, key time of year to really look at that deadline of Roth conversions having to be done within a calendar year. Again, 1/1 to 12/31 is your timetable for doing that, for it to be counted on a year. And again, you can't do that in the following year. So if you know that you're in a lower tax bracket this year, or maybe you have some headroom in your tax bracket this year and are going to be making less money or would just like to get into a Roth IRA, then now is really the time to kind of look at that and say, hey, look, is it a good idea for me to do this? Call your tax preparer, really be analytical with it, because the other parts that go into a Roth conversion are not just simply saying, hey, I'd like to convert cash, and it may very well be that for you. But if you have assets, let's say you have a piece of real estate or an LLC or a trust or a note, you have to have a proper valuation of that asset done prior to the conversion being done, and they're only good for 30 days. So being strategic with getting a valuation done so that way you can convert and maybe split that between 2 years is something that a lot of people do fairly often at Advanta, and it's definitely better something to start doing now, because we're going to need to review it. If there's any issues, we might need to get things done. Again, people are busy. You have Thanksgiving, you have Christmas, you have Hanukkah, you have New Year's. So getting someone to do a valuation, if it's a real estate appraiser that needs to be engaged or an attorney, people take time off. Again, if you are looking to convert things other than cash, now is the time to start it, to be able to get those ducks in a row so you can make the conversions happen before year's end if you want to get something counted on this calendar year. All right, so got some questions. Good time to take a look at some of these. Okay, let's see. I own a self-employed business. Can I pay my 10-year-old kid, or any rules for child Roth or traditional IRAs? Yes, I mean, if you have a business, you can certainly have your children do activities that would qualify them to have a Roth IRA for the purposes of contributing to that plan. However, it's not necessarily for me or Advanta to say, how you should do that. Again, the general rule is they need to have it needs to be substantive. You can't come in and pay them, $7,000 for shredding documents for a day, right? I would get with your tax preparer CPA to say, hey, look, I'd like to have my children come in. Can I pay them $15 an hour, pay a minimum wage, something to do some work, and then so that way I can qualify them for making contributions. There are certainly mechanisms for doing it, but again, people that specialize in tax preparation and advice would be the people best looking to would be the people best suited to answer that question specifically. But can you do it? Absolutely. Let's see. What happens if I have pre-tax traditional IRA and want to do a backdoor Roth conversion? Does it have any pro rata rules that apply if my income's over 250K? So what this individual is asking is if they have to make an after-tax contribution to a traditional IRA, when they convert it, is there any pro rata of the taxes since they already are making it non-deductible? Depending on the amount of income and whether or not that there are earnings attributable to that non-deductible contribution, there may be a pro rata that can be taken, so you don't necessarily get hit with double taxation. But that's simply always going to be contingent on how much earnings that may be attributable to that conversion, and what your current income looks like. So again, you have to file what's called Form 8606 when you do that, for tracking a non-deductible contribution basis to a pre-tax retirement plan. And I know that sounds like a lot, and it is, but at the end of the day, it's something best to ask your tax preparer to figure out exactly how much headroom and how much you would potentially be looking at non-deductible conversion basis, because that might make a determination depending on how much income you have, whether or not it's better to convert that non-deductible basis in the traditional IRA this year or next year. So a lot of careful planning kind of needs to go into that when you're looking to convert that non-deductible traditional IRA contribution into a post-tax Roth. All right, got two more questions and then we'll keep moving on. Let's see, partner owner in a capital investment partnership that currently invests primarily in SFR new builds, looking for a way to fund the business without taking a withdrawal from existing IRA. Can you open a self-directed IRA and issue a loan to a business which you have ownership? The distillation of that is that if you own a business, can you loan the business money from an IRA? The answer is yes, but there is some contingencies on that. One is that you can't have a majority ownership interest in it, or a group of disqualified individuals, meaning anyone that's a direct familial interest to you, so mother, father, son, daughter, spouse, can't be the other primary shareholders. So if you own potentially less than 50% of a company, can you lend money to that company from an IRA? Yes, potentially, but I always encourage people, if you're looking to do something like that, talk to an hour of an attorney's time is, the ounce of prevention and pounds of cure equation really comes into play there. So is the potential for that to happen? Yes. Can you lend money from an IRA to a business you own? Yes, but it's definitely something that gets very specific on how much ownership you have, and whether or not you should be doing that is something if I was going to do it, I would absolutely pay for an hour of an attorney's time to review it, write me and a letter of opinion on it, and would move forward at that point. And then last question, can I lend money from my solo 401k on a promissory note to a private business? Yeah, absolutely. You can lend money from a 401k to really whomever you'd like. You can't lend it to yourself personally. Going back to the last question, could you lend it to a business that you own? Again, depends on the ownership percentage, but 401ks also allow for personal loans to be issued. So let's say you did have a situation where you maybe wanted to lend to something that you couldn't directly do from a 401k to a business you wholly owned or something, you're allowed to lend yourself personally from a 401k up to $50,000 or half of your vested cash balance as a personal loan that has to be repaid with at least a quarterly payment at a point above or below prime at 4 years. So you can absolutely do that, and if that gets you across the finish line for what you need, it's a great option. A lot of flexibility with solo 401ks. One of the reasons I really like them, and I encourage people to look strongly at them, especially the small business owners or self-employed individuals, is that they offer very high contribution limits compared to the $7,000 or $8,000 that traditional and Roth IRAs allow for in a given year, and a lot of flexibility on the timeline in which you can contribute to those as well. A lot of great questions, keep them coming in, but that does get us through the questions that we had. Again, to recap on Roth conversions, if you are looking to do a Roth conversion this year, so whether that's the quote unquote backdoor where you made a traditional IRA contribution and want it to be Roth because your income limits, that has to be done this year. Even though you can make a previous year traditional IRA contribution, you cannot do a previous year Roth conversion. So if you're looking to do that, it's important to get that account open now to convert it, because otherwise you would have to count that potential, there. And again, there's the potential for some double taxation there. You really need to look at it carefully, because doing conversions is January 1 to 12/31, but contributions can be made next year into the previous year to count this year. So an important distinction to make. Again, so looking to do Roth conversions, now is the time to look at that. Again, once the clock strikes midnight on 12/31, too bad, so sad, everything's going to be in 2025. So employer-based plans, what are they and why are they so awesome? Well, you have basically three different options if you are a small business owner or a small business owner or a self-employed individual. These are basically going to be designed, for, again, those tightly held companies. Granted, seven simple IRAs can have a lot more employees in 401ks. Heck, companies with hundreds and thousands of employees can have 401ks. But for the purposes of what we're talking about and how these plans work and talking about contribution limits, we're talking about self-employed individuals. They're for sole proprietors, independent contractors, self-employed people, small, closely held partnerships. They can be for corporations, and especially they work great for S corps. SEP and simple IRAs offer tax-deferred growth. Now, 2 years ago, they did write into legislation to have a Roth SEP component and a Roth simple component. However, it is still in the very beginning stages of us being able to offer that service because the IRS is just now writing the reporting codes for making after-tax contributions to those plans. The nice things with business plans is that there's no income limitation for doing Roth component contributions to these plans. So if you maybe are phased out of doing a Roth contribution directly and you want to take advantage of higher contribution limits, well, employer plans might offer that. So if you qualify for one and you want to do that, again, great time to look at it because now you're going to be looking at, hey, how much headroom do I have for making a non-deductible contribution to a plan? And as of October 15th, all contributions for employer plans are now done for 2023. So coming into 2024, now is when we're looking at making this year's contributions and obviously the beginning of next year, potentially making those. Again, much larger contribution limits, and they're going to be based on a few different factors, depending on what plan you look at. SEP IRAs are going to be based solely on the amount of comp being paid to the individual. Simple IRAs and solo 401ks look at both the amount of compensation for the types of contribution and the amount of revenue a business makes. And again, depending on how you file the taxes for that business is going to determine how you run those calculations. Things like a sub S corp, it might just be the total revenue paid to the shareholder is going to be constituent of the compensation and the net operating income of the business. Whereas maybe if you file as a partnership, it's going to be different insofar as that you have a dedicated bucket that you're looking at for part of the contributions based on the net operating income, and then also a separate amount that you have being paid as comp or a distribution to a partner. So again, I know it's a little bit of a cheap answer, but checking with a tax preparer or CPA or someone that understands your personal taxable situation, especially if you're a business owner, is key in this because it's not for us to make that determination for you. And they're going to have, kind of the keys to the kingdom to understanding, what your best options are and how to most accurately utilize these types of great retirement plans. So again, solo 401ks are by far and away going to offer the largest amount of contribution for a given amount of money. And they are also dedicated Roth options for a solo 401k that are up and running right now and have been for years. So the SEP and simple IRA. What type of employees can be excluded from these plans? Individuals under 21, non-resident aliens, and collective bargain covered union employees. So these are the people that can be excluded from these plans. Again, if you have maybe a few different people that work for you, it's important to understand with the business plans who can be excluded for the purposes of calculating contributions, because calculating the contributions for part of it, when it comes to the employer match portion, has to be defrayed, at least with a 401k, over the number of active participants. So just because you maybe look and say, hey, look, this number looks great, I can contribute it. If you have a qualifying employee that works for you, then that number is going to get divided by the number of eligible employees. So again, important to understand that. And then what employees must be included for a solo 401k if they worked over 1,000 hours a year or at least 500 hours for 3 consecutive years. For SEP IRAs, those who have worked at least 3 of the last 5 years, and simple IRAs, you must include anyone that has received at least $5,000 in compensation during either of the last 2 years. Now, with simple IRAs, an employee can opt out of it as well. Any of these plans, there is the ability to opt out. The simple is a little bit easier for people to opt out, but it's very important to understand when looking at, hey, how much contributions can I make is, hey, how many employees do I potentially have? And again, that can be a little bit different for everyone. Now, the IRS did redefine a common law employee 2 years ago with the Secure Act 2.0. It used to just be 1,000 hours a year, and then they brought in the 500 hours over 3 consecutive. So there have been some tax law updates. Again, they have permeated pretty well. I'm sure most people understand that, but maybe you haven't, but it's not just kind of the benchmark of 1,000 hours per year anymore for an employee. Now, what are some of the advantages of going with the SEP or simple versus the solo 401k? They can be less expensive to administer. Contributions are made to IRAs. You don't have any fiduciary liability. Individual employees, if you have them, can choose the IRA custodian. You have flexible contribution and distribution features. And employer contributions only to those employees with 2 years of service with a SEP IRA, and you can exclude anyone with 3 years of service with less than 3 years with a SEP IRA. So again, determining which one's going to be the best fit for that, again, important. The SEP and the simple IRA can also be established next year for making any and all contributions for this year. So you have a good amount of headroom next year. However, with the solo 401k, you do have a bit of a deadline for how you are going to be determining all of your contribution allowances. You can make there was a change this year that allows for that also to be lumped into the other group. So all of these plans can be established next year for making a contribution in the previous year for all of the different buckets of money that come in. Previously, coming into 2023, you had to have a solo 401k established by 12/31 to be able to have the allowance for the extended filing deadline for making all of your previous year contributions, meaning that your salary deferral, which you defer out of your comp, the plan had to be established by 12/31. Now that is not the case. You can establish a plan up until your extended filing deadline. So the 15th of last month, I was establishing plans for people to make all of their contributions for the previous year for those plans. SEP and simple IRAs have a few different deadlines, but nothing at least immediately coming up as of December 31 that would necessitate necessarily having the plan open. However, again, the sooner you get the plan open, the sooner you can start making investments. You can defer that money, make your life a little bit easier come tax time. But again, we do have some additional flexibility that has come in for this tax filing year. So not as much of a kind of race to the finish with the solo 401k like we saw in previous years. Now, some advantages of the solo 401k, you have higher funding limits. Basically, you have two different buckets. For a solo 401k, you can contribute out of your compensation to the tune of $23,000 per year with an additional $7,500 kicker if you're over 50 and a half, plus an additional 25% of your net operating income, not to exceed a total plan contribution limit of 69 grand, of $70,500. Of total plan contribution limit. So you have a very high amount of contributions that can be made to it. You don't necessarily have to have the same consideration for just taking a percentage of comp like a SEP IRA does. So, let's say you had $50,000 or say you had $100,000 of income, the solo 401k is going to offer a significantly higher amount of contribution limit if you're a self-employed individual than a SEP IRA would. SEP IRAs is 25% of comp, so $100,000 of earned income, you have $25,000 that you can write off into a SEP. Again, that does reduce the amount of income shown, and it is always a business deduction. Now, with a solo 401k, you can take a personal deduction of $23,000, and the plan can contribute, and the business can contribute another $25,000 into that plan as well for you. So again, you're going to have a significantly higher amount of contribution allowance for a solo 401k when you compare apples to apples between a SEP and a solo 401k with the same amount of money earned. Now, again, that's not to say the solo 401k is the best fit. If you have a lot of earned income and you don't have a lot of gamesmanship with how your comp is paid, think real estate agents, people that get paid everything out on 1099. If you have that kind of income, a SEP IRA can be very powerful because it especially allows you to reduce that amount of money that's shown to be exposed to FICA and FUTA. You don't necessarily have the kind of gamesmanship that can be utilized with a 401k with having monies maybe kept on the LLC side versus what is paid out in comp. So solo 401ks do offer additional flexibility, but there is some simplicity that's offered with a SEP IRA that may not necessarily preclude it from being the best option. And simple IRAs, they do have their place. They're not nearly as common. I maybe open up 3 to 5 SEP IRAs per year, as opposed to, maybe 50 to 80 solo 401ks and maybe another, 80 to 100 SEP IRAs. So again, it's just not nearly as common because the contribution limits aren't as high. And I'll go specifically into that here in a minute. But again, solo 401ks are something, especially for business owners, I really like because it does offer a significantly higher amount of contribution limits. And it has a dedicated Roth option that is very well established and utilized by people. There's no kind of guessing on how the IRS is going to have these reported. And again, anything new with the IRS, I would be wagering to guess that there might be some issues with the reporting for them accepting it in. So definitely some keys to consider. In addition to that, you also don't have many constraints for the end of the year anymore like we used to. So here's everything kind of enumerated for you. We have the traditional and Roth IRA. Your contribution limits for this year are $7,000 or $8,000 depending on your age. Keeping in mind that the Roth IRA does have a preclusion from being able to directly contribute to it if you are making over a certain amount of income, depending on your tax filing status. Again, I would check directly with the IRS, depending on when you're making the contribution to the plan as to what that is going to be, because it has started to change more periodic than it has in previous years. So if you're listening to this later, again, that's my encouragement for you. SEP IRAs, you can contribute up to 25% of your compensation or up to $69,000. So that's your total plan contribution limit for this year. You take your total comp, multiply by 0.25, and that spits out your allowance for that contribution. Now, if it's over 69 grand, excuse me, then again, you cannot contribute any more than that. But it's a very simple calculation to make. And you can establish your SEP IRA up until your extended filing deadline for making a previous year contribution. So again, you have a lot of flexibility with that one. Doesn't have to be done by year's end. But if you did want to make any of these contributions that we're looking up over here and do a conversion of any of these contributed amounts, you have to do that before the end of the year to have it counted for this year. So again, remember, you can establish a SEP IRA next year and make a previous year contribution. But if you want to have that counted as Roth funds and you want to pay those taxes this year, you got to do it before 12/31. Same thing with the traditional IRA. You want to make that and convert it for counted on this year's taxes, got to be open and converted by 12/31. Simple IRAs, again, the contributions for that, you can contribute up to $16,000 of your comp. If you're over 50, you get another $3,500 on that, plus up to 3% of an employer match that is based on just a match of their elective contribution or 2% of the employee's compensation. So these plans, again, aren't as popular just for the simple fact that there are plans that offer more contribution limits, but you do get a little bit of that hybridization between the SEP and the solo 401k with a reduced overhead of operating expenses for the simple IRA. The solo 401k offers you the ability to contribute up to 23 grand of straight money that you are paid every year. So if you pay yourself 30 grand, you can pay into that plan $23,000 and reduce that taxable income to almost zero. You get an additional $7,500 of elective contribution if you're over the age of 50. And you also get a salary and you also get an employer match. So think about, when employers say, hey, we'll match your contributions. The way that works for a self-employed individual is you can match up to 25% of the operating income of the business, not to exceed a total plan contribution. So the $23,000 or the $30,500 if you're over 50, not to exceed a total plan contribution limit of $69,000 or $76,500. Again, total plan contribution limits. These plans also offer a really cool aspect of making after-tax contributions personally to make up that differential between the employer and employee match. Whole webinar dedicated to that because that's definitely a little bit more of kind of like a graduate level examination of these plans. But solo 401ks, again, are some of my favorite. They offer such high degrees of cost-effective savings, as well as the ability to blend Roth and traditional funds, and a lot of discretion on how you administer those funds as well. The ESA that we kind of covered briefly in the beginning of this, $2,000 per year. You have until your filing deadline of April 15th or whatever day it falls on to open that plan and contribute to it. In the HSA, again, you can open and fund that for the previous year to the tune of $4,150 for an individual and $8,300 for a family plan, plus $1,000 catch up for anyone that is 55 plus. Again, the key to remember for big year-end deadlines is if you want to do any type of conversion of contributions, whether that's to a SEP, simple 401k, or traditional IRA, you have to get that plan open, contribute the money into it, and convert it before year's end if you want it counted on this tax year. Everything else can basically wait until your filing deadlines for the individual plans or extended deadlines for the business plans. But again, that's the big caveat that people tend to overlook, is that there is no mechanism any longer for doing a previous year conversion. Okay, I got a few questions. For a solo 401k, how much percentage should be paid as salary on the net income? That's not a question for me to answer. That's definitely more of a tax preparer answer, because it's going to depend on what your exposure to tax liability is personally, and that's going to boil down to, are you in a no income tax state? Do you have state or local taxes to be considered of? It's not necessarily just a round percentage. It's going to be dependent on, again, where you live, what your tax situation looks like, and what benefit you're trying to maximize. Let's see, does the 23K in the solo 401k include the full-time job employer plus self-employed solo 401k? Okay, so here's a really good question. You are allowed to be covered if you, let's say you have a W-2 job, right? You work for, I don't know, let's say you work for Microsoft, right? Which congratulations if you do. But you're covered by their 401k plan, and you elect to defer $23,000 out of your compensation. You max out your Microsoft 401k. Well, if you have a solo 401k, and let's say you have a consulting job on the side, and you made 100 grand that year, again, congratulations on that. But you cannot make a double elective deferral to the 401k. The $23,000 is going to be based solely on the total aggregate of all of your 401ks. So if you made, let's say, $23,000 of contributions to Microsoft's plan, you can make zero of that elective deferral to your solo 401k. However, you can absolutely still participate in the non-elective portion. So the business match, you can participate in multiple different 401ks and maximize that benefit. There is no kind of netting out of other benefits that are paid by other employers, but the 23,000 or the 30,500, depending on your age, is going to be an aggregate total between all of your retirement plans that you are an active participant of. So again, great question. One that doesn't come up too terribly often, but it is very important that people understand that. And the last thing that I would bring up with HSAs, because you do have a kind of a little bit of time left, if you want to take advantage of making a full year's contribution for an HSA, you have to have your high deductible healthcare plan coverage bound by December 1st. So this Sunday, you have to have that coverage in place to be able to make a previous year full year contribution. It's called the last day of the first month rule. I just did a presentation, I want to say about 3 or 4 weeks ago, on HSAs, dedicated to HSAs. Actually, it was on November. Actually, it was on Halloween. I remember we had kind of a fun title for it. So if you want to learn more about HSAs and you were considering doing it, that contribution availability for making a full $4,150 or $8,300 contribution for this year, you have to have that healthcare coverage in place by December 1st. Now, you can make that contribution next year, but you had to have that coverage bound by 12/1. Again, if you want to look it up, it's called the first day of the last month rule. And we got another question. See, if an employee contributed 23K into a solo 401k, can the employer match 100% contributions? No, a 401k doesn't match the contributions made by it in this sense. If you file as a C Corp, there's different rules for how you calculate contributions to the plan, but for anyone that's self-employed, again, I think I've run into like 2 people that individually file like their business as a C Corp for a closely held business. But basically it's not based on the contribution. It is a percentage of the revenue or the operating income of that self-employed or solo business. So you can do anything up to 25% of that total number. Now, if that is a sub S and the total comp is based on the total revenues of the business, yeah, you could potentially do 25% of that, but you're not going to be able to do 100% contribution match to the individual in that kind of thinking. Now, if they contributed, let's say they're over 50, right? And you've contributed 25 grand into the plan because that's what you wanted to do, and the employer match was also 25 grand. Yeah, I mean, that looks like 100% match, but it really isn't, because it depends on how you run that equation. It can look like it, but it's not going to be calculated like that. So again, 401ks definitely are the more complex one to look at, but with that complexity adds additional benefits such as administration. It adds additional benefits such as higher contribution limits, and as well as options for pre and post tax with those types of plans. And remember, contributions are not earnings, right? So your contribution to a plan, if you're making money on a contribution in a plan, that doesn't reduce your amount of available contribution in any given year. You can still make as much money as you can, which I encourage everyone to make as much money as they can in these retirement plans, but contributions don't reduce the amount of contribution allowance you have. Also, expenses paid by an IRA to a particular asset don't reduce your contribution limits either. Contributions are always available to be made to a plan, no matter how much money that you may have potentially made or will make into a plan. Also, transferring funds into a retirement plan, whether that is an intra-IRA transfer, so where we go from one IRA to another, that doesn't reduce or eliminate your availability of contribution allowance. Moving funds directly from one IRA to another is a non-taxable, non-reportable event that doesn't affect your contributions. Direct rollovers also do not affect this. So if you're moving funds from an old employer's plan to an IRA, or vice versa, moving in from an IRA to an employer's plan, that does not affect your contribution limits either. And indirect rollovers also do not. So if you took a distribution from a retirement plan and decided within 60 days that you were going to roll that back into a retirement plan, does not affect your contribution allowance. Now, indirect rollovers do have a timing period of once every 12 calendar months, excuse me. But again, they do call rollovers rollover contributions. If you do some research and you look online, you will see them called rollover contributions. Does not affect your ability to make your regular IRA or 401k, SEP or simple or HSA contributions. They are completely separate, it's just the terminology used. But it is important because I have had clients, and often enough where I like to mention it, that do get hung up on that you do need to be considerate of that. So if you're interested in getting started with something like this, it's basically as easy as just reaching out to myself or one of my colleagues, and we can get you started on the process of getting the account open and funded, and then ultimately finding the investment. More specifically to what you're concerned with right now is if you're looking to do a conversion, or if you're looking to set up an HSA and do that, you have some considerations. Remember, if you want to do a conversion of anything, 12/31 is the witching hour for that. You got to get either if you don't have the account open and you're looking to do a conversion, open it to make the conversion. If you have an asset that you'd like to convert, you got to get that. Again, you got to get the Roth IRA open, and then you have to get the valuations done to get that conversion done by 12/31 for anything you want counted on this taxable year. So there's not necessarily many restrictions for years in for establishing accounts just for the purpose of making contributions. But if you want to make any type of conversion from pre to post tax, so from traditional to Roth, you got to get that done by midnight on 12/31. So again, just leave you with a few rules. Again, we did kind of cover a few things, that there are prohibited investments, potentially lending money to certain businesses. Again, that can be problematic. And you also can't engage directly with anyone that's directly related to you. So mother, father, son, daughter, spouse. I think it's always good to kind of end these off with a few of the rules that people, maybe aren't necessarily exposed to when normally using IRAs. And a good infographic right here of the people you can and can't directly transact with. So buy, sell. Again, there are some potentials to lend money to these people. So again, if you do want to get more engaged with us, our events, they typically are at least 2 or 3 a week. This week, we only got the one with Thanksgiving coming up. We have our podcast and our blog, which are great areas to get some more information. If you want to reach out, we're happy to help you get your account open and hit those deadlines by the end of the year. Again, with that said, my name's Alex. I do really enjoy doing these and bringing education to people. Thanks for all the great questions. If there are any additional questions, I'll hang out here for a minute for anyone that wants some questions answered. If you do want to grab a copy of the slides, they are attached as a handout here, so you can download them directly. Or if you would like a copy, just feel free to email me directly. My email is right up there on the screen for you. So again, everyone, thank you so much for joining with us today. I hope everyone got some great information out of it. And have a wonderful and happy Thanksgiving.